Today, we're welcoming Omar Yehia, Princeton Grad, formerly investor at Arrington Capital, and who now created his own fund. He also has an interesting background as a rocket scientist. And in this episode, we'll be talking about investing, raising, and building during the bear market and the return to sanity in the crypto space. So, Omar, you have a very interesting background, as a very prolific investor. You spent some time at Arrington Capital. You now launched your own fund, but you also have interesting background in applied mathematics and physical science and all of that. So how about you tell us a little bit more?
Absolutely. It's nice to be here, Simon. Thanks for having me. I started off spending a lot of time in academia, like you said, where we studied a lot of very interesting physical problems and then tried to look at the theoretical mathematical foundations that underlie these problems and how you think about the physical world. That's not so relevant or immediately relevant to venture. You might ask, what someone from your background, what is he doing in this space? And to that, I'll just say it helps a lot to be quantitatively minded and being very numerate and think about things from first principles. And something we chatted about offline at some point is how venture in America actually started. And if you look at the history in the 1950s and 60s, it started with Fairchild Semiconductors, where William Shockley, who was a very prolific physicist, he won the Nobel Prize with John Bardeen for their work on transistors. They essentially spun off corporate ventures or research arms of corporate enterprises in order to try and build and monetize the products that they were building in their research labs. And then through sort of iteration, they realized that by giving the scientists equity in what they were researching and sort of economic upside to that research, they were able to very quickly iterate and produce products that normally wouldn't come out of a research lab. So that's how it sort of started. And now we see a shift where, when you see some success in any particular field, it attracts people that are people from outside of that field. Venture became a lot more associated with finance, people who had sort of economic background. But I think you can never stray too far away from having technically minded people, because at the end of the day, we are building, people in the space are building software that requires a lot of relatively sophisticated understanding of mathematics. So.
Absolutely. So now you have your own fund. What is your focus at the moment? Tell us a bit more.
So we do very early stage venture. The earlier the better. Sometimes we like to say pre-product, but sometimes even pre-idea. We think that our niche in venture and our edge comes from working very early with founders, helping them with the ideation. Once they have some sort of framework of what they want to build, designing the architecture, doing sort of proof of concept simulations on whatever architecture that ultimately ends up being designed. And on a personal level, we think that's just very fun. It's a very fun thing to do, and it is worth our time. Yes, in many ways, but we also like to build ourselves, which is slightly different. So we don't really hire people and ask them to do things. We just sort of play around and ourselves, and then if we find an idea that's sort of half useful, we find people that are sort of more clever than we are, and we tell them, hey, if you think this is a good idea, maybe you make a real product out of it. So that's sort of our approach, and it really is, like I said, very, very fun. And it's also, I would say, the riskier part of venture, because it's so early that there's almost nothing there when you are committing capital to these sort of ventures. The team, there's barely anyone there. There's generally not a clear idea or a road to monetization or even a road to product. So you're really taking on a lot of risk, but this is the type of risk that we're here to underwrite. And it's what our investors want us to underwrite. So.
Right. So it's really dabbling down on the founder and the vision.
Yeah, precisely.
Awesome. Okay. So, you talked a little bit about like the paradigm shift around like how venture capital started and how it evolved, and the fact that now we're going back towards having more specialized people when it comes to software and like almost like scientists and engineers. What have you seen specifically in the crypto world over the past year, and what's happening right now? Is the market changing? Any specific thought around that?
Sure. So in crypto, it's interesting. We've replayed a lot of the dynamics that occurred in like venture capital markets in the last 50 or 60 years, just over the span of like a decade. It started off as being a very niche sort of hobbyist topic. Nobody would touch it beyond, you know, the cyberpunks on the internet. At some point, maybe around 2013 and 2014, there was enough of the community around it that it started to appear on the extremely long tail of like risk assets, that you can actually build something or invest in something in this space. Extremely risky from a technical standpoint, a regulatory standpoint, and so on. But that's when perhaps it showed up on the radar. In about 2017, 2018, it became what I would say an investable asset class, in the sense that enough people knew about it and enough capital allocators were interested in the space that you could really start deploying some meaningful amount of capital. But again, this was still all led by the technologists. What I think happened more recently, it's about 2 or 3 years ago, it really became in the spotlight. It really fell in the spotlight, and larger, more traditional financial players, including Web2 companies, banks, large venture capital firms from Silicon Valley, really started to get interested. And so you started to have a shift away from the technologist first approach to the more traditional venture approach, or at least it was the same players that were coming into the space. But I do think that, like I said before, you never stray too far away from the technologist, only because as the technology becomes more sophisticated, you still have to be able to underwrite risk, even as some of the technology matures. And there's no way to do that, and there's no shortcuts beyond really understanding what it is that we're building on, what kind of primitives need to be built, and what kind of parallels that we can draw from like the traditional finance world, the fintech world, to Web3. So there's really no way escaping it. It's whether the charge is driven by the technologist or more, you know, traditional financiers. But yeah.
Yeah, especially when it's still in the building blocks, whereas in a lot of the software world, is that a problem we can solve? Is it useful? Will there be user adoption? Whereas here it's still, is that part of the building blocks, like deep below the iceberg?
That's right. No, that's right. In many ways, I think I make this joke where I say in 2013 and 2014, critiques would come in the form of you know, this is not possible. You know, having a form of like cryptographically secured private money, it's just not possible. And probably around 2016, 2017, the critiques were, it's possible, but it's not useful for anything. And around 2019 to like 2021, it was like, it's possible and it might be useful for something or another, but nobody will end up using it, just because it's sort of technologically inferior than anything that we have today. And now I think the next phase of critiques is going to be, well, it's possible, it might be used for something, and it might be technically superior for certain applications, but there's too many risks and, you know, and regulation and you know, these sort of critiques, and so now we're not going to use it. And so I think the same way in like science, where, you know, science progress is one body at a time. I think in the critiques of technology in the space will also sort of fall very slowly and surely, but you will continue to have these waves of pessimism or pessimistic opinions after some sort of euphoric optimism, and it's just the nature of markets. I think it's true beyond crypto, but the funny thing about crypto and Web3 in general is that a lot of the development is done in public and openly, on, you know, on Twitter, for example. So you just get to see these dynamics very vocally, and you get to see both the proponents and the critiques of these enterprises all over the world, sort of at any given point.
Right. And so talking about this, what do you think are the main problems in VC today, in crypto? Is it, is it people pushing their own candidates? Is it conflict of interest? It seems like in traditional VCs, there is also this ethics where you can't really invest in a competitive company. We've seen a lot of crypto companies actually not really applying that rule, whereas if it's a crypto VC or even a public relation agency, it seems like the competition still hasn't really been defined and is a little bit blurrier. So anyway, those were two examples. There might be way more ideas of what could be some potential problem of the currently what's happening in the venture capital in crypto. So what are some of the challenges and some of the problems that we're facing today?
I mean, I could go on about this for a while, but let me say probably the most important problem is on the financing side, on the venture capital side, there still is not enough like technical prowess or technical competence for risk managers to underwrite a lot of that risk and like prudently allocate capital. So just from my experience, there are a lot of people in the space, both, and really to be fair, on the builder and on the investor side, that are not extremely familiar with like the technical intricacies of what's being built, which it's okay to the extent that you're making money. I mean, if you invest in something and have no idea what it does or how it even becomes monetized, and you end up making a lot of money on it, it's okay. You're forgiven. All is forgiven. But when you have downturns and when you have people coming back and asking why exactly it is that you invested in at vertical A or vertical B or assets or this asset or that, then it becomes much more difficult to give like a coherent response. So I think just really going back to first principles, understanding what a blockchain is, how these networks are built, what the architecture is, what they're useful for, what they're not useful for, what are the technical prospects, what are the challenges. We can't say with certainty what is possible, but there are many things that we can say right now that are not possible. And it requires understanding how these things are built and certain cryptographic primitives and why we use one type of cryptographic scheme versus another. I mean, cryptography is an old topic. It has existed in its modern form, maybe since the 70s or the 80s. Now, there's been a lot of like technical progress since then, especially on like the primitives that people use, but like a theoretical understanding of cryptography has existed for a long time. And when you meet investors or builders in the space that are just completely unfamiliar with that history, with that literature, I'm always taken aback, because as at least from the venture side, it's almost part of your duty as like your fiduciary duty to your investors is to say, these are my areas of understanding, of competence. This is where I'm comfortable underwriting risk, and this is sort of my strategy. I'm not going to try and catch every single investment, but the ones that I do invest in, I should be able to very coherently express a thesis as to why I think it's going to work. And you probe around in the space and you'll see just that really is missing. But with most emerging enterprises or industries, you see a lot of that. But just off the bat, it is a very technology heavy space. So I'll say it again, there's no shortcuts. There's no expedience. You just have to understand what it is that's being built. So.
Right. And I think from that emerged an interesting, type of investment groups, which is the DAOs, right? And so a lot of them included people that were in the crypto space since the early days. A lot of them work inside protocols. There's a lot of technical people. It enables a bigger group up to, if you want to be an accredited investors, up to 99 people. Before the regulations were there, even more. So this gives kind of access to a pool of more technical people, depending on who is part of the group, obviously, and potential more expertise. So do you think there is any, and we've seen a lot the success of this group, especially starting by the Lao, that has shown incredible success. And so that kind of, has Meta Cartel, the Lao, that have kind of started this wave. Would you say that there is any chance the DAOs could investment DAOs, the venture DAOs could overtake VC. Any thought around that?
I think as like an idea, investment clubs have existed for a long time. Just having sort of an open-ended vehicle where people can come in and put small contributions. You form an SPV and you use that to do the investment. That has existed for a long time, but having this being on sort of the internet or being internet native, where it's accessible to everyone and in all geographic locations, and it's sort of trivial because there's very few capital constraints if you're using a base currency like Ethereum or any of the non-sovereign forms of money. But while that's interesting and the accessibility and transparency of it is very interesting, I still think there is a major role for the risk manager, for a small, might I say, centralized group of people that are ultimately entrusted by their investors to make very specific decisions. And once you have a structure that enables thousands or maybe hundreds of people to participate, where it's not clear where the final say in terms of the risk management lies, it becomes more difficult for the average investor to come in and say, I'm going to entrust this group of people with my money. Now, we've not seen that on scale or en masse yet. So I'm very hesitant to dismiss the idea of it, but I do think at the end of the day, that investors, they fundamentally invest in managers first. Conditional on that, then they're interested in what the strategy is of the fund and whatnot, but they really are investing in managers. So I don't think that ever goes away. But I do think there is an equilibrium where these sort of investment DAOs, where they exist, and perhaps perhaps their niche is slightly different. I mean, they can do things at scale, perhaps better than a traditional venture firm. Maybe they can outsource a lot of what a project needs or a protocol needs to a large and diverse group of technically minded people. So to the extent that they can do that, I think that they have certainly a place on the table. But do I think that they ultimately end up just completely replacing the traditional venture capital structure? I don't think so. At least it's not clear to me why that would be the case.
Now that makes sense. I mean, there might be an evolution in the way things are being done. Like we see some more scout programs evolving. So VC kind of almost outsourcing the way they sourcing deal flow and a few experiments. But I agree with you. I think it might take.
I think in many ways they can work together. I mean, a good venture capital firm doesn't do everything. It has a core set of competencies, and it tries to focus them. Like the managers try and focus the majority of their time on working with the teams and doing investments. Everything else that can be outsourced, that's not directly related to that relationship, can and probably should be outsourced. I mean, in fact, we do this all the time. There are many administrative, legal, accounting work, all of that. There are third parties that will happily do this for a premium, and I think that's certainly worth your time as a risk manager, as an investor. You want to spend the majority of your time doing what you like and what you're good at, which is participating in the venture capital world and not worrying about the details. So to the extent that these investment DAOs can bring something to the table and help venture firms focus more on what they're good at, I think there's certainly room for collaboration.
Awesome, thank you. And talking about venture capital and deal flow, do you want to tell us a little bit more about what's exciting for you right now? Your general thesis. What makes Omar?
That's an interesting question. So on our thesis, we have like overarching theses and then sort of smaller theses depending on the vertical that we're looking at. But we fundamentally think that blockchains are like censorship resistant communication networks that people can use for a variety of things, payments, communication, computing. So having a sort of a global, transparent, censorship resistant market for computing, all of these things. There will be primitives that I think, while today they seem niche or maybe even odd, I think in maybe a decade they will become so native to the way in which we handle communication and money on the internet that we'll ask how we live without them. There used to be this, and I think this is still a point of contention. There is this paradigm of let's do everything on chain. Let's try and push as much data on chain. Let's try and update the state in front of everyone, sort of transparently on chain, because that is sort of orthogonal to the past, where we had to trust centralized entities to update the state for us, and for them not to censor our behavior, these sort of things. But I think now there's a slightly more interesting paradigm, which is a natural evolution of this sort of composable computation paradigm, which is a provable computation. This idea that I can now ask a centralized entity to do a calculation for me without having to trust them in terms of the integrity of the calculations. That's what like validity proofs, or some people refer or talk more broadly about like zero knowledge technology, but really we're talking about validity proofs, this idea that you can do a calculation for me and I can trust, all right, I can trust the maths rather than having to, the integrity of the maths rather than having to trust the integrity of the operator. And there are players in the space that are obviously doing a tremendous job, Stockware being one of them. What they're building on StockNet and StockX are a manifestation of this idea that we're talking about, moving as much as possible off chain, but without having to trust anyone. We think that these are very interesting sort of computational paradigms. And you know, today the infrastructure is very much nascent. It's still being built, but I think in perhaps a decade, this will be an extremely common way of interacting with these public ledgers using validity proofs to sort of outsource the majority of the computation burden.
Mm-hmm. Yeah, that's I think this is something I've seen also. There's this kind of on-chain hype, and then we've seen recently a little bit more concern, a lot of people being concerned around having everything on chain because now it's you can't remove it and everything is curable, and it's like, is that the future we really want? So it's interesting.
Well, privacy is another completely different animal, and it turns out, depending on sort of the architecture that you're dealing with, you can have sort of privacy as a service where you can, you know, encrypt certain things and or hide certain things and natively not hide others. Or it can be completely native to the protocol or to the network itself. But these ideas have existed for a long time. Doing sort of homomorphic encryption, for example, at scale is a well-known problem in like distributed systems. Again, adding layers of privacy to financial transactions or to personal information. Again, primitives that are being worked on today, which I think are very, very interesting, and I think are absolutely necessary. I don't think there is a prospect for a financial infrastructure in which it's completely transparent to everyone. I mean, this is certainly not how we live today, and I don't think in any way this is a plausible view of the future. I think you need these primitives. I think they were not at the spotlight. It was first, can we get these networks to work? Can we get them to function? Once we were sort of okay with that or happy with that state of the art, then we move on to say, okay, well, how can we add privacy to them? Or maybe even how do we develop a native infrastructure for privacy? So.
Yes, privacy has gone from like being the evil, we want to hide all the bad things, it's a potential good option if it's as a service.
With most things, it can be used for, you know, useful enterprise, or things that are not so useful. So, but the technology is agnostic to that.
Exactly, the tool itself. In terms of so as you mentioned, there's quite a few things that are being built at the moment that are quite exciting, from different primitives, but also just all different levels in this ecosystem. Are you excited about the bear market from the building perspective, or is that a little bit worrying, the fact that there might be less money to experiment and being able to build different tools on top of that? How are you feeling around the building in the bear market?
What bear market? So
All right.
so in
I
many
might
ways,
publish this episode in 2 years then.
no, in many ways, we don't like our theses aren't really influenced by like market dynamics. In many ways, they're just tested by them. A lot of what we've seen built in like the last cycle, and we're referring to this idea of a cycle, which means it's sort of normal, or we think it's normal. A lot of what's been built, having a constant influx of capital, can sometimes hide or obscure like the usefulness, the utility of a lot of different products. Because at the end of the day, we're talking about markets, and the way in which markets present information to people is through prices, right? At the end of the day, if you have an obscured price signaling because of like structural reasons, let's say people are constantly deploying capital into the space for reasons that are not necessarily, people, allocators are not sitting there evaluating the state of technology and saying, yes, we think it's undervalued at this price, and so we're going to bid up that price until we're trying to acquire it at a higher price until it's bid up to fair value. That's not really the dynamics that's going on. You had a sudden inflow of capital, which meant that a lot of founders in the space would have gotten the signal that certain types of financial or cryptographic primitives might be useful, and so they sort of started working on them, only to realize that no, this was not really what was useful, and this was just like an artifact of capital flowing in. So a lot of what we thought maybe could be plausible because of what the market was perhaps signaling may in fact not be plausible at all. So that's one thing. Another thing is, when you live in a world that's fueled by credit, meaning that you have an artificially low cost of capital, a lot of enterprises seem viable in that regime. So that so long as the cost of capital continues to be like structurally low, whatever the equilibrium value is for the cost of capital, then certain types of businesses are plausible. But will we always live in an artificially low cost of capital environment? I don't think so. I mean, that's generally what has changed in the last 12 months or 6 to 12 months. Then all of a sudden, many enterprises or many business models just don't work. So one of the things that we look at is when someone is presenting an enterprise, we say, well, does this business model, does it work in all environments, or does it require a very specific economic environment for it to thrive? And we're generally weary of that, because at the end of the day, you are building a business. However way you look at it, it is trying to accumulate resources, use them to build some sort of product. That product ultimately brings economic value to the system in the form of some sort of cash flow. So I mean, we're describing a business. So businesses that only operate or only are only viable in certain types of economic environments, we are very weary of that. So it's always good when the economic environment changes and changes abruptly, because it forces all market participants to reevaluate the business models that are being funded.
So just to summarize, you're saying that the cost of capital within the past, like this past couple of years, might have been fairly low in terms of people could get high credit with low interest, and they could also, because of the influx, after 2018, the kind of hype again around crypto, there's been a big influx in terms of venture capital amounts. So both on that side, there's a lot of funding, and because of that, a lot of companies have been funded, a lot of good ones, some of them that might have less useful or less sustainable business model. But as the state of the market is changing, everything is being reevaluated. And so when looking at an investment and when looking at a product itself, it's very important to consider two factors, which is the cost of capital and the state of the market, which eventually are kind of intricately linked. Is that correct?
That's right.
Awesome.
And making sure that whatever it is that you're building, and if it looks good now and it maybe looks potentially profitable, make sure that it's not just a direct consequence of the cost of capital being low.
Right.
Uh,
So is everything still priced in?
no, that's an interesting question. I don't think everything at any point anything's ever really priced in. I think markets hover around an equilibrium but never really get there. You know, we can debate whether we think markets are or not. If markets were truly efficient, I don't think any of us would have a job. So.
Mm-hmm. Yeah, I mean, the reason I'm saying that is because you know, the valuations reached a I mean, if I don't even know what would be the right word for that. Just they're very high, and
Usually, speculative mania is the word people use.
yes, absolutely. So the manic state of the market has maybe stabilized a little bit, and is maybe going towards a less manic state, but it's still, it seems like things are still high. So, you know, I don't have the overlook that you do. We don't see, I don't look at like 10, like 50 projects every day. So from your perspective, is it reaching a point where it seems to reflect the true, and obviously true value is also very like subjective, but are we still in a state where the valuations are very high, or are we reaching a kind of more reasonable point?
Well, I think it depends on what you mean by reasonable. There is definitely now a sort of return of sanity where as one should, people are asking, how exactly does one arrive at the valuation? How do we value these enterprises, which are in the early stages? There's no prospect of cash flow. The product's not even clear, so people have to think about, you know, how exactly we arrive at these valuations. And you know, in cases or in markets where capital is abundant, the supply and demand. If you think of you know, investment opportunities just being a good that people are bidding for, when you have a lot of capital, the price of that good is just going to get bid up, regardless of the value of the like the inherent value of that good. And when, you know, when the cost of capital becomes higher, and when there's less liquidity, and when it's less sort of you know, firepower, and people have less money to invest, then they just start taking their time and they really start asking themselves, you know, what exactly is it that I'm trying to buy? So, and this really is far removed from just crypto. This is the nature of all markets, and we've seen this for hundreds of years, both in venture and in public markets. So there's nothing new under the sun here.
So it's less of a speed run to making all the companies unicorn, but just taking time and helping them one step at a time.
That's right.
Yeah. Okay. Recently, we've seen a lot of merger and acquisition, with Uniswap Labs acquiring the NFT marketplace aggregator Genie. We've seen eBay acquiring Non-Origin, and we've seen also FTX acquiring BlockFi. That has made a lot of noise because the amount was surprising, which was 25 million. So will we see a lot more M&A in the future, or do you think the companies, a lot of companies will die in the crypto space, given the state of the market?
I think again, this extends far beyond crypto. If you look at like 2008, in the banking crisis, where it was a huge liquidity crisis, when instead of having like tens of banks, I think maybe only something like 40 or 50 banks with common household names, at the end of it, there might have been 4 or 5 banks after consolidation. In whatever enterprise where you have an idea that seems good enough, or like a vertical that's interesting and maybe profitable, and people are deploying capital into it, you will always see the rise of competitors with slightly different differentiating features. And usually for some path dependent reason, or for some reason or the other, one of them happens to capture the majority of the market share. And it makes it structurally difficult for its other competitors to continue to operate on thin margins. And so what happens is you have these acquisitions, and these acquisitions are typically triggered by some sort of liquidity crisis that pushes people over the edge. A company that's barely profitable can continue to chug along until one day you have a big liquidity crisis, and its profitability drops to where it's now burning cash, and then it's just a ticking time bomb before the company essentially goes bankrupt. And then you have these interesting opportunities. So this is, you know, it happened in 2008, it happened in 2001 with the dot-com bubble. and it's certainly going to happen. I think undoubtedly this is a feature of, again, all markets in which you have a lot of competition and projects with or companies with similar outlooks but slightly different differentiating features and slightly different cost structures and capital structures.
And
I have
most
no doubt that well capitalized companies in the space. The obvious example is FTX. They will have wonderful opportunities to come in and reduce their cost structure by acquiring, and they've been doing this through good times and bad, by acquiring companies that would be useful to their enterprise. So.
Yes, and going back to what you were saying around the burning kind of capital. I mean, most crypto companies are not profitable right now, which is, I mean, fairly normal because it's, took them a few years to build the product. There's still a nascent market. So it's kind of the case of like most crypto companies, right? In terms of there's no real, most of them are not cash flow positive. So when it comes to business models, do you see a change in business model? Because what has been happening is a lot of company launching tokens, kind of paying back the investors through token raising price, and then no clear revenue model because a lot of those companies want to be open source. Is it something that's changing right now?
I think certainly people are much more skeptical of this idea of the dream trades, where people are investing in something that it's unclear how it's going to make money, but it's going to become big enough. And again, that's common in traditional venture. It's going to become big enough that, we'll worry about it or it's a problem that'll solve itself later. I do think one always has to have some idea of where the business is going to make money. But if you look at some of the most successful enterprises, Amazon being a very good example, at the beginning, if you were a venture capitalist trying to invest in Amazon in the 90s, there is no way you would have predicted that the majority of revenues or the sources of majority of revenues that Amazon has today. It was not clear at the time. So you still have to be flexible and open-minded in terms of the business pivoting and changing the way it operates and the way it generates revenue. But you still at any given point, you still have to ask yourself, how is this enterprise going to make money? If that question is not at the forefront of the discussion, then you will never really be able to price that investment. You'll never really be able to say, well, what can I expect? Assuming, very simple back of the envelope sort of calculations. What can I expect in terms of the profitability of this investment? So without having any sort of business model, it becomes essentially you're shooting darts you're throwing darts at a wall, which I just don't believe is the right way to do any sort of investment, or the right way to found any company. I mean, at the end of the day, you don't have an infinite amount of resources. You have to build a team. Your employees have to be paid. You have a cost of running the business, which means you have like a natural timeline for when you need to start being cash flow positive, or you need to at least start covering your costs. So these are questions that you have to think about from day one. There's no way around it. If you continue to just kick the can down the road and you just rely on, perhaps we'll be able to have some sort of like pseudo equity claim on the company using a token or something, and perhaps it appreciates in value, and maybe we'll get some sort of liquidity event and we can use that cash. I mean, even that approach at some point will fail. So assuming that you have a perpetual bull market, at some point you will run out of tokens to sell. So even then you still have to think about what product or what good or service I'm trying to offer people in perpetuity, and they're sort of happy to pay me a price or a margin for it. So, in any enterprise, how the business ultimately becomes profitable and how it makes money is the fundamental question. And if it's not on our minds, I don't think we're doing our jobs properly.
So it could be that there are many options and many ways to make money.
There are ways to kick the can down the road, and there are ways to to just temporarily push it under the rug. But it is a specter, or it is a ghost that will never be able to escape. You have to be able to answer how this enterprise is going to make money.
And you might not know exactly which one you're going to pick, but you can
Which is
see
okay.
a
Which is okay.
canvas with several different options. And if a founder can't think of all the options, or at least several, then it becomes a little bit concerning.
Yeah. And you have to act upon it too. It can't just be, one day in the future when we have 100 million users, we'll switch on some feature that will get us money. This is not a practical approach to generating sort of cash flow. You have to work with what you have now today as well.
And it seems like people don't really want to launch token during the bear market. They try to wait for the better moment to do that. Do you see less tokens being launched, more liquidity deals being done?
So a token is just a way to incentivize users or agents in a system to behave in a certain way that they may not necessarily behave otherwise without the existence of a token. But the question to answer is, or to ask first rather, is does everything need a token? If I'm building a business on Web3, does that mean I need a token? I mean, absolutely not. There are plenty of enterprises that function if you have an operating structure and you have like a product market fit for something users want, and there's no reason, and the users are naturally inclined to interact with your system in a certain way, there's no need for a token. They're behaving exactly the way you want them to behave. Let's say you have a food truck and you have a very special expertise in producing a very certain type of sandwich, and that sandwich is coveted and people want that from all over the world, and they will show up from all over the world to have your sandwich. There's no need for a token in that system. If you make a good sandwich, people will show up and they will buy your sandwich. It's not clear to me why you would need to incentivize people in a different way. Now there are, some perhaps ways that are not very obvious in which you can use a token in the system. But in general, there are many systems in which people are naturally incentivized. In fact, if you think about the economic prospects of most businesses, people are naturally inclined to approach these businesses and ask them for their good or service, and to the extent that they can, the business can provide that good or service with some sort of margin, and then both the user base and the business exist in perpetuity. So a token is a tool, but it is not the final result, or is not the final outcome that should be expected from any sort of Web3 venture. That there will be a token that will appreciate value. That's just not the I think the proper way to think about it. It is a tool that can be used as part of a system, but it cannot be the entire point of the system.
Mm-hmm. Yeah, and one of the ways could be to incentivize all the participants to kind of stick with this protocol, right, or this specific platform. We've seen like NFT marketplaces, for example, rewarding, kind of distributing, or even DeFi protocols, or anything really, distributing more tokens or more, even like ETH to people, to holders, or to people who trade on that platform to kind of reward them. So it seems like there's a few ways where they could incorporate.
If I have let's get like a simple example. If I have a system in which, let's say I have a house, and and I need 10 people in this house to put a library together or something, or assemble some furniture, and I have some edge in assembling that furniture. I can do it better than, I as a foreman or I as a supervisor can tell these people to build this furniture cheaper and better than anybody else can do in the world. But the problem is I need the people to show up to my house. So in order to incentivize them to show up to my house and not anybody else's house, perhaps I introduce some sort of economic incentive through the use of a token. And maybe people who show up early are disproportionately rewarded than people who show up late. And so, but contingent on the fact that I need those people there. Once they show up, then my real business can start. And it was a problem of bootstrapping users. So maybe an incentive there makes sense. But once they're there, the token is no longer interesting because they're being economically rewarded for what it is that they're building. And I have an edge in terms of like the margin. I'm able to through my prowess, I'm able to have them build the furniture in a very cheap way or something like that, or in an elegant way. And so then the money machine starts. So in many ways, the use of a token can be transient and not, it doesn't have to be used in perpetuity.
Mm-hmm. Very interesting. Going to people building companies and introducing tokens or not introducing tokens, what do you see founders lacking the most of? right now? And also maybe something quantitative also, what do they have the most of? Just the overlook of talent and founders and skill sets.
I think, and so at least let's start with the pros. I think a lot of founders in the space are extremely fascinated, passionate about the space, which means they're intellectually curious and they're willing to stick around through hell or high water. And some, like a good amount of them, are very technically inclined. They do understand the state of the art and they are interested in building space. So that is definitely a positive. One perhaps area that needs work is, at the end of the day, regardless of what you're doing, you are still operating as a business, like we discussed before. You need to think about how you manage a team, how you hire people, how you incentivize people for the long term, how you interact with the community. In many ways, it's just like a PR position or a PR function. You need to do all of the standard functions that a normal business would do. You need to be like familiar with how to keep your costs low, how to extend your runways, how to not burn unnecessarily through cash, so on. Just good old like business acumen, I think. And I think because this crypto venture did not exist, or Web3 enterprise did not exist 10 years ago. So it is naturally a space that that has operators that are much younger, which means there was not enough runway for people to have that experience. So I think as the space matures, entrepreneurs in the space will just evolve in a way that they naturally fulfill these gaps.
And that's where you guys kind of come in. I mean, you and the rest of the VCs and incubators and accelerator, where they can actually come fill those gaps, right, and help with advice or just kind of different areas. Correct? How do you approach that?
Absolutely. I think as a maybe a piece of advice to founders in general, I think you ultimately, as a founder, you're not looking for capital. Capital is sort of the minimum viable requirement, but you're looking for partners. You're looking for people that are excited about what you're building and want to help you build.
So you're saying that founders, when they're raising money, obviously there is just a term sheet with like some numbers on it, but eventually what they're really looking for is partners. That's tough though in this I think probably there's a little bit more leverage in terms of what the leverage that founders can have when the cost of capital is low, as you mentioned. But in this state of the industry, as founders need to make sure they have runway, they might have less choice in terms of what kind of partners they pick, just because everyone is more prudent. What would you recommend for them in terms of, they need money, they might not want to take anyone's money, but they still do need it. So how would you navigate that?
So I think regardless of the macro environment, I think if there is a really good idea and a strong team behind it and a clear need for that in the market, so there's a real potential for product market fit, I think you'll able to find willing capital allocators. But more importantly, you want to find partners, people who are excited about the idea, excited about the team, want to behave as almost like an extension of the team to bring something to the table that perhaps the founding team doesn't have. And together they bring the enterprise to life. The point that you mentioned is interesting, which is sometimes it's more easy to raise money than other times. And the answer to that is, well, there are other ways to raise capital besides equity. Equity is by far the most common one, at least in crypto. But debt financing is one option. Grants from certain ecosystems is a common one, albeit much smaller. So I think, like most things, the answer is somewhere in between, where you incentivize potential partners to come work with you by selling them equity in the business, but you have to be very careful and specific and selective about who you bring on board in terms of the investor. And then whatever the remainder of the balance of the capital that you need to raise to operate the business or start the business, you can raise through some mixture of like grants or debt financing and so on. Like you don't need to come in and sell 20% of your equity right off the bat, or if you don't need to, or perhaps just for the sake of raising capital. If it's just for the sake of raising capital, there are other ways to do it. Now, of course, raising capital in many ways is easier on the founder's side, because it's money that's not owed. When it's debt, it's a liability that you need to return, and a principal and an interest. And so there's a natural sort of time that you have to act on. The business has to be profitable within X amount of months, or you're running into a wall because the cost of financing that debt becomes so high after a sufficiently long time. But selling equity it's not a liability anymore. People simply own that equity, and you can do whatever you want with that cash. So it's a two-edged sword in that way. But I think, like always, that what you're trying to build is an extremely valuable enterprise. So try and limit the amount that you sell that enterprise to, as much as possible, and instead do what you can to operate a lean business that does not require like a lot of capital before it starts generating revenue or profits itself.
Be conservative for a second.
always conservative, and be prudent.
That makes a lot of sense. In terms of Web2 companies, a slightly different topic. Web2 companies started to adopt Web3 a lot, which is one of what we like to highlight in the news. In many cases, like, wow, like TikTok is launching NFTs, and eBay and all those different companies. Some of them seems like it makes a lot of sense. Some other NFT collection launched by a specific artist or even like just company in general might seem a little bit more questionable and opportunistic, not to name names. But with this kind of macro environment, do you feel like a lot of Web2 company will back out, or will it give them maybe more confidence in the fact that there's less hype and it's clear to see where the technology is without having to dig for really where is the foundation layer?
I think in most cases, for successful like Web2 companies, they have a reasonable business model. They have a large user base or a large client base, and they're generating profits. Now, but there are certain inefficiencies in their business model that perhaps can be alleviated, or maybe they can increase their client base, or a combination of both, by introducing a Web3 element, by using some sort of primitive that's developed in Web3. That I think exists in favorable macro conditions or unfavorable macro conditions. The only difference is the risk appetite for these types of ventures. Is it worth my time as a Web2 company? Because Web2 companies are also, they're affected, in a similar way by macro conditions, right? When the cost of capital is high, their margins become thinner, and they have to worry about staying lean as well. So maybe we don't have time or capital to start looking at, trying to explore these Web3 primitives. But to the extent that these Web3 primitives are useful to them, and they are able to help them, increase their or fatten their bottom line, I think there will always be an appetite for that. But the question is, in what is the risk profile for a lot of these Web2 companies? And a lot of it, for better or for worse, also has to do with optics, right? As the shareholders of the company might not think that it's a great idea when you're, on the verge of laying off perhaps 10% of your workforce because of economic conditions. Maybe it's not the best time to go and explore NFTs if it's not core to your business model. Now, your shareholders might not be as visionary as you are, for example, and you might see something that perhaps will revolutionize the way your business is run. But still, I think you are beholden to market conditions in some way.
Yeah, absolutely. I think optics is a big part of a lot of what has been a lot of the crypto features launched. It seems like there was also a dabbling down on sorry, I'm kind of jumping all over the place here, but I just thought about what you said like 2 minutes ago around protocols and ecosystem grants. It seems like a lot of VCs when with the macro state of the market, and as you mentioned, even like core components, it seems like a lot of companies or firms are dabbling down on helping their existing companies and especially protocols that are growing their ecosystem rather than exploring new avenues. Is that what you see internally, or is that just something that might be a misperception?
I think in many cases, once you've already committed some capital and resources to one ecosystem or the other, you're incentivized to stick with it and see what you can really make of it. And a lot of it is a learning process as well. You know, you're a different person a year ago than you are today, because in terms of your understanding of the ecosystem and in terms of how quickly it's evolved. You look at some of the ecosystems that we have today that are, I would say, leading in terms of at least capturing the mind share and some economic value. They didn't even exist a year or 2 years ago. Look at Solana, you look at Avalanche, you look at Starknet, which is what Starkware are doing. I mean, these companies are barely, or these enterprises are barely a couple of years old. So and they've evolved tremendously since inception. So there is the long-term incentive for investors in the space that have come in at the early stages to continue their support and their learning and understanding the system, and helping the founders of those ecosystems continue to build and expand.
Mm-hmm. Mm-hmm. Yes, that makes sense. Well, we're coming to the end of this hour, Omar. I want to ask you a question, and then I will leave it up for any side comments or thought. But Omar, how are you defiant in general?
How am I defiant? I guess one form of defiance is me coming on this podcast, because I generally don't do these, because I'm very suspicious of people talking of their own books. So I really find that amusing sometimes. But I think one very interesting thing about Web3 is that it's very transparent. People build in public a lot. Which means it's open for critique, but it's also open for promotion. And I think it's it does the space and the founders in the space a great disservice when people are out there promoting certain ideas that are just either like technically just completely false or at best questionable. And it either comes from a place of misunderstanding or a place of illiteracy or some combination of both. And I think it is very important if you, on the other side, if you identify these sort of misrepresentations, that you say this publicly and openly, and even without having a dog in the fight. There is still some sort of shared responsibility to hold people to a certain level of intellectual honesty. And part of being defiant is by trying to uphold that honesty with everyone that you work with in the space. And I think this is a common good, a public good, that we will all benefit from trying to maintain a certain level of rigor, a certain level of public honesty, intellectual honesty in both what we're building and what others are building. It is okay to be building on one ecosystem and acknowledge the advantages and the pros of another ecosystem. There's nothing wrong with that. It's also okay if you genuinely identify a technical flaw in your ecosystem. It is okay, in fact, is encouraged for you to be intellectually honest about it and say, hey, this is where we stand today. This might not be the best design, or this might not be the best way to do things. We're going to change it, or perhaps, perhaps this was completely misguided, and maybe we should shut down the enterprise. All of these intellectually honest responses or statements are very helpful. And part of being defiant and part of being a good builder or operating